So we've seen what the standard theory is on Fed policy, on monetary policy, how monetary policy is supposed to work, what the Fed expects to happen when they buy or sell bonds. And we've seen a lot of theory like this, a lot of stuff that looks great and works great on paper. Problem is, in the real world, things aren't always quite so simple. The real world is messier. The real world isn't a ceteris paribus kind of environment, as we've talked about. And a lot of Fed policy has failed to achieve the goals it was looking to achieve. Fed policy has, at least arguably in some cases, created unintended consequences elsewhere, as have other economic policies that were implemented because they really did look good on paper. And then things didn't quite work out in the real world. And that disconnect between the world of theory in an economics textbook and the real world, when some of these theories don't appear to work sometimes, has led to different schools of thought among economists to try to explain this disconnect. Where you have some economists saying that the theories are sound, the policies were done exactly the way they should have been done, but there were other things that interfered. Or the theories were sound, but the policies weren't implemented correctly, but we should still look to try to design policies around these theories. And then other economists who say the theories have no real resemblance to the real world and should essentially be dismissed in favor of other approaches. And over time, a lot of these different perspectives have led to different economists finding themselves in different places, and different labels have developed to describe them. And it is generally expected that if you've taken principles of macro class, you're familiar with some of the basic labels. So the competing views on monetary policy tend to divide most generally into two categories, hawks and doves. And I kind of insist on the quotes here that you see on both hawks and doves, because I've always thought these names are kind of off. They seem to, you may have encountered a difference between hawks and doves in other contexts, in the context of military policy, where you have hawks who favor more heavy military intervention and doves who favor pulling back and leaving well enough alone in terms of military intervention. And we tend to consider hawks to be more right of center politically, affiliated with the Republican Party, while doves are a little more left of center politically, affiliated with the Democratic Party. In practice, things are never quite that simple, but in general, that is kind of where the trends go. So this is at least my theory as to why, when it comes to monetary policy, hawks describe people like, as you see, monetarists, classicists, Austrians, who tend to be more right of center and associated with the Republican Party, and doves are typically the more Keynesian-oriented economists who tend to be more left of center and more associated with the Democratic Party. In other words, if you're a hawk, if you're with the hawks on military policy, you're with the hawks on Fed policy. And if you're with the doves on military policy, you're presumed to be with the doves on Fed policy. And it seems a little off to me, because when you consider, in the context of military policy, a hawk is someone who wants to take some place in the world where there's something off, and we want to use the brute force of the military to fix it. We want to rush in and either not think about unintended consequences, or say that we can do it without having the unintended consequences happen, or say that the unintended consequences are worth it for the goals we're looking to achieve, and you're being really active, while doves are more of a pullback, let things play out the way they're going to play out. Even if we don't like the results, you're only going to make things worse, or you're at least likely enough to make things worse to where it's not worth the effort. Now, when you think of that when it comes to monetary policy, the doves are the ones who want to swoop in with the brute force of the various levers of monetary policy to try to move the economy in a different direction, The hawks are the ones who are going to say there are unintended consequences that are going to rise from this. You're going to do more harm than good. You should pull back, let happen what will happen. Basically, the hawks want to be non-interventionists, while the doves want to send in the militant tools of monetary policy. So it seems kind of the reverse to me, but whatever. That's just my opinion. The labels are what they are. If you talk about hawks when it comes to monetary policy, people in general, wherever you go in the world, if you're talking to economists, they're going to understand that you're talking about someone who wants the Fed to play a much more neutral or passive role, where if you're talking about doves on monetary policy, those are people who want to do everything they can in terms of monetary policy, or they want the Fed to do everything it can to get us the best economic outcomes possible. And I pretty much only have Keynesians here. There are a few other labels for other types of economists. There are various brands of Keynesian, but the Keynesians are really the more prominent ones. Same thing on the hawk side. The monetarists, classicists, and Austrians are the ones you're going to hear the most about, but there are maybe some other labels out there that we don't really need to concern ourselves with. But there are some differences between monetarists, classicists, and Austrians. Monetarists are probably the most dovish of the three when it comes to Fed policy. Again, that means that they're the ones who are the most likely to want the Fed to intervene, and they would prefer central bank intervention in the economy over fiscal policy intervention. They seem to believe more in monetary policy than fiscal policy, while Keynesians are the reverse. While Keynesians seem to agree with monetarists that monetary policy can be effective and Keynesians will oftentimes support monetary policy, Keynesians tend to prefer fiscal policy. It just seems a little less. When you're playing around with the financial system and the banking system, there are some dangers there that pretty much every economist is going to recognize, and you want to be careful about pushing ahead with monetary policy if you don't have to. If fiscal policy can take care of it, then good. Fiscal policy isn't always there to take care of it. You need a lot of politicians to agree with each other, which is why monetarists and Keynesians may be a little bit more likely to favor monetary policy intervention. However, monetarists are still a little less likely to want to increase the money supply. Like classicists and Austrians, monetarists are a little more concerned about inflation, while Keynesians are a little more likely to say a little bit of inflation is fine as long as we get unemployment down. Monetarists are more likely to want to engage monetary policy to target inflation, to try to keep inflation low in pretty much every context that you possibly can. Classicists and Austrians tend to want less Fed intervention on either side of things, but classicists tend to be a little more okay with the Federal Reserve existing just as a way of stabilizing the banking system. And if you're going to have fiat currency, which we pretty much have to have, we talked about how other currencies and maybe cryptocurrencies will take over someday, but as of now, that it's easy to imagine how they never will. It'll never be stable enough. It's too volatile and not universal enough. While fiat currency is always an easier thing to implement, but if you have to have it, you do have to have some sort of management of it. So classicists tend to be a little more in favor of that sort of thing. Austrians are the ones who pretty much say just get rid of the Fed, go back to the gold standard. Whatever bad things are going to happen there, we'll adjust, we'll adapt, but at least we'll never have to worry about becoming Zimbabwe, essentially. So there are three different degrees of hawkishness on Fed policy, while those on the dove side tend to have a little less distinguishing them from each other, which is why I pretty much just leave Keynesians there. And that really is, those are the differences between them in a nutshell. Beyond that, there's really one more thing to get to on monetary policy, and again, it's kind of like knowing what a hawk and a dove and a monetarist and a Keynesian, etc., are in terms of monetary policy. You hear terminology all the time, and it's good to know what it is, and that is when we are talking about the liquidity trap. You may have heard of this. It makes its way into the news a lot, especially when we have Fed policy that drives interest rates down. It comes up. It becomes a concern. And the concern here has to do with the assumption that we want more dovish monetary policy. Again, that means we want more intervention. And lowering the interest rate generally through the buying of bonds to push that supply curve to the right and drop the price of loanable funds, that's generally perceived as the way to get things going in the economy. But if you've dropped interest rates all the way to zero and you're still in a recession, now you're in a pretty tricky place because you can't drop them any further. You're already at zero. If you go below zero, and in some cases when you factor in inflation, you've heard about negative interest rates where you're essentially getting people to pay you to take their money for a while. I'll give you $100, you give me back 99. And people will do that sometimes because they're afraid that other investments will lose even more money, and if they hold their money in cash, basically they believe that there are going to be losses in the short run, so that's the minimum loss. Is kind of a simplistic explanation as to why private individuals will still buy bonds when real interest rates are in negative territory, but you still can't really push them down anymore. But you also don't want them to stay at zero forever. But if you raise them up out of zero, you start to contract the money supply during a recession when there's insufficient demand in the economy. You run the risk of making the recession even worse. So you're in an impossible no-win situation. You have to hope that something else gets you out of the recession, after which you can start to raise interest rates up again. So quantitative easing happened right after the 2008 financial crisis. A major recession that happened now about a dozen years ago. And Fed policy kicked into gear, lowering the interest rate, buying bonds aggressively, and the interest rate got to essentially zero, and the economy was still stuck. Even if the recession had bottomed out, it was still not growing very much. So to respond to this, the Federal Reserve did what's known as quantitative easing. They bought even more bonds. They bought more than just government securities. They took over a lot of some of those bad mortgage-backed securities we'll talk about in that last bit of stuff we talk about in the semester. Some of those bad loans, that toxic assets, you may have heard of them. They bought those off of the bank's books. Did a lot of stuff that couldn't drop the interest rate anymore, but could still increase the money supply to try and rev things up. And it was still years where the Fed was stuck in that liquidity trap before it could start letting interest rates rise a little bit, and now we're back to starting to look at lowering it back down and hoping that it comes back up. But that is what a liquidity trap means. It means your interest rates are at zero, you can't go any further, but you still want to go further and you don't want to bring them back up. You're trapped, you're stuck. And it's liquidity because it means that you need more liquidity, but you can't get any more. You already did as much as you could, essentially. And again, the Austrian types and more right-of-center hawkish types worried about inflation. And it didn't happen because banks held on to those excess reserves. They didn't loan them out. They didn't really do anything with them. And so some economists have said, well, we're going to have to pay for that eventually, and we will still have really high inflation. But high inflation really, that has to happen if the economy doesn't grow as that money gets lent out. And so the money has been lent out to fund economic growth projects, M times V equals P times Y, but Y is going up, which is why M is going up, which is part of why we haven't seen hyperinflation. Just to cover that part of things. So that is it for monetary policy. And we'll get into the next section after this video.